Good afternoon. What do you want out of life? Imagine, if you will, a personal digital avatar that provides you with advice, provides you with assistance to think about how to spend more wisely, or save more wisely, or invest more wisely. The purpose of the Commonwealth Bank of Australia was to secure and enhance the financial well-being of people, of households, of communities, and of corporations. And the purpose of Barclays is to help everybody meet their ambitions. So what do you want out of life? In a banking relationship 40 years ago, our parents would go to the bank manager after having made an appointment, and they wanted to think about how they were going to provide for an extension on the house, or renovations to the kitchen, or to buy a new house, or to buy a second home, or to get into shares, or to buy some retirement products so that they could meet their ambitions. So everything depended upon that intimate relationship with another person, and it was highly inconvenient. It took a lot of time to arrange, and now we're fast forward into getting real-time advice in a deep, intimate, secure, and convenient relationship at scale. So a computing model that started 40 years ago is still running, and we're competing with Tencent and Alibaba and Amazon and Google in a completely new online relationship. The computer is still being asked, what do we want out of life? So real-time relationships in a digital world. We want to help people meet their ambitions in the right way. Now, if our data structures and if our processes and our applications are all based on a model of a bank 40 years ago, the account structure and the product structure is at the root of the database. And the process relates to questions they were asked in the branch when somebody had to come into a physical branch and ask for an account balance, or ask for the movement or transition of money in a payment, or the receipt of a loan or an overdraft. So think about that. All those data structures still exist, and all those instructions are still in the rules of the systems that were architected 40 years ago. So through the cloud and through virtual development, we have to move away from all of that legacy architecture, data, process, system, and exit. But the majority of banks, whether they're in Europe or America or Asia, are all running on these old data models, on old process and old applications. And the regulators are saying you can't move quickly to the cloud and you can't move quickly to agile development because it's too risky. So in the meantime, the Chinese companies and the Asian companies have leapfrogged the American companies. They've looked at all the client-server models and they've looked at all the web models, and they no longer have any process. And the data structure is no longer on account, it's no longer on product, but it's on the customer, the roles that they play through their economic life, the relationships that they have with all of the other people that they interact with, and all of the other business interactions they have with any other entity. So we have a complete divide between old institutions based on old data structures and relational databases, hard-coded into monolithic systems that can't make easy calls from mobile applications. That's the majority of banks. The majority of startups, there are 13,000 new FinTech startups. 13,000 new FinTech startups. In 1 year, in the last year, 34 of those have become more than 1 billion in their total valuation. So in 1 year, that has trebled in value, and they're now worth more than the market capitalization of Barclays. It used to be the 4th largest bank in the world. So in 3 years, and particularly in the last one, 34 startups are greater than the value of the 4th largest bank in the world. They're the startups. The competition from the large new digital native businesses that have only grown since 2008. So Alibaba and Tencent. Alibaba got into small business lending and consumer finance in 2008. It is now called Ant Financial and is wholly owned by the Alibaba Corporation and Jack Ma. And the combined value of that payments business and lending business is greater than the market capitalization of Barclays. So in 3 years, it has trebled in size. So what does a legacy business do to compete with either the small-scale disruptor or the large-scale, wholly digital challenger? If you look at MIT data, it will tell you that the source of competitive advantage is in those assets that you either own or control that are sustainably differentiated from the competition. So from a digital and IT point of view, it's platforms and applications and the ability to create competitive platforms and competitive applications, and for the features of those applications and platforms to be better than your competition on a sustained basis. But if you look across all of the banks in the world, whether they're providing mobile services or online services or call center services or direct bank services into branch, they all look very similar. So how do you achieve outperformance? Outperformance is only ever achieved when a decision is made of higher quality, more frequently, and executed faithfully. So the new forms of competitive advantage are no longer the applications and the platforms that run the applications, but the following 6 things. The ability of your workforce to be able to do development in agile, to lean bad process or legacy systems, to do data-driven analytics, to design products and services, to be able to do that in rapid data-driven experimentation, and to partner with the right technology provider that is going to change your business model and allow your people to work directly with the customer. So if all of our competition is in the cloud, is doing rapid, agile product development, and is delivering that through high-frequency experimentation, those are the new skills that our staff have to have in order to beat any competition, whether it's coming from a startup or coming from a large new challenger. And the intelligence or know-how of the algorithms, the data, has to help people closer and closer in real time to help them make a decision. Should I spend this money on this car? Should I have a license, a lease, or a loan? Do I need insurance with this? What form of insurance do I need? When I make this decision, what impact is it going to have on my savings? And if the impact on the savings is going to affect my asset base, what is available for investment? All key decisions of customer requiring deeper and deeper meaning in the insight and more context, so closer to real-time decision making, whether it's a spending decision, a saving decision, or an investment decision. Currently, the majority of banks around the world do not have the real-time capability to transfer value, to acquire new customers, and to dig into the insight of those customers. So they're being disintermediated by Google, Amazon, Apple, Tencent, and Alibaba. All of our customers, whether individuals, whether households, whether small business or corporation, want anywhere, anytime, simple and convenient transfer of value. Whether that's a security product, whether that's a banking product, whether that's an insurance product. But the ultimate is the real-time transfer of value, which is increasingly becoming without any friction. So no doubt you've been to presentations where people have talked about cryptocurrencies or the movement of assets across distributed ledger technology. And all of that technology is about to disrupt traditional banking or traditional payment schemes. And it might. But for as long as the bank is providing trust and loyalty and security and can protect all of the transactions and all the assets and all of the value associated with the data, increasingly that data is becoming more and more important than the transfer of money itself. But we must be in a position where the bank can transfer immediately upon instruction and not extract rent from that transaction, and not extract rent from holding the deposit, but rather making sure that it is only charging for the creation of value. So using the data to help people spend more wisely will create value. Using the data to help people save more wisely will create value. And particularly using the data to help people invest more wisely, provide them with investment options that are suitable and specific to their risk and their loyalty profile, and only offer them in the instance the right investment under the right criteria, creating the right amount of value that the bank and the individual, the bank and the corporation share value. So I'm going to show you a video of a simple, easy to use example of immediate transfer of value in real time, making it very simple, anywhere, anytime. Will you play the video, please?
Mobile banking. Fabulous, isn't it? But at Barclays, we know there'll still be times you need to speak to your bank. So let's play the life quiz. What's your memorable place? Your memorable date? Are you sure? Correct. Your first pet's name. Ah, yes, little Barney. Or was it Birdie? Barclays mobile banking app makes it easier to speak to us because it already knows who you are. Just press the new Call Us button to be put through to someone. So the hardest question you'll need to answer is, hello, Mrs. Reid, how can I help you? For all your little trials, you can rely on your bank.
Intimacy, trust, and convenience, and value. No matter which device, which application, or which channel you choose to use, and have them all available in next to real time. And that is the cost of doing business, and that is the level of convenience and value that every customer requires. Now, when the new challenges or the new startups are unable to provide that level of intimacy, trust, security, and value, we have all the necessary know-how and knowledge and capability to deliver this and stay ahead of that competition. So what's next? Providing the same level of intimacy and privacy and real-time decision-making that we had 40 years ago when the bank manager saw your parents and could do a decision in the instant, but do that at scale, and rather than have 30 clients a week, have 30 million customers a day. Without the loss of that intimacy, without the loss of the privacy, and the ability to do that real time at scale, without taking unnecessary fees and only transferring value and receiving payment for having created that value. For people that we serve, for any client that we serve, for any household or company or community that we serve. I'm going to finish up on the last slide to just show you that there are three forces of value. The ability to acquire customers at scale at zero marginal cost. The ability to compute at scale and use the knowledge and insight from all of that data to create customer insight. And not just have that computational capability, but to convert that into real-time customer value. So if you look at the inside of the circle, Alibaba and Tencent can acquire millions of new customers at 2 and 3 cents per customer. Most banks are still doing KYC at $170 to $1,700 a customer. Amazon and Google and Apple are processing the majority of payments in the Western world, and they've surpassed the total amount of transactions that are running across consumer schemes in the US and in parts of Europe. And for Barclays' role, as we look out into this disruptive environment, who do we turn to? Do we partner with Alibaba? Do we partner with Tencent? Do we partner with Apple or Google or Facebook or Amazon? Or do we partner with the startup companies? Do we take on, like many banks have done, have startup incubators, they have accelerators, they have R&D labs where they're working with startup companies. Some of them are buying these startup companies, and nobody knows. The truth of it, nobody knows. But all we know is that the force of the startups, the large challenges, and these new internet-only digital companies is forcing this greater intimacy with the customer, forcing this easy acquisition, and forcing any business, whether they're in banking or logistics or any retail, fast-moving consumer goods, to being increasingly next to real-time or real-time in the transfer of value. I believe that adopting the technology of the new Tencent and Alibaba straight through all digital on-cloud model and using the smarts of the startup where they can produce a product and service continuously through the day and produce that in agile and produce it through digital experimentation and to make the decisions in real time based on data analytics. Using the combination of that, a 325-year-old institution based purely on lending and the transfer of value will leapfrog the Chinese, will leapfrog the Google and Amazon and beat the lean startup to remain in business for another 325 years. So with that, I'm open to questions. Thank you.